Welcome back to 4 Wheel Finance. In this video, I'll be breaking down how much you need to make in order to afford a 2023 BMW X5. I think you should really consider following one of these rules in order to avoid making a huge car buying mistake that will end up setting you back for years financially speaking. I've also got a link to a free auto quote where you can save up about $600 a year on your car insurance in the description below, but more on that later. There are 4 options I'll be going over today, and you can decide on which one suits you the best depending on how into cars you are. Some people just want something reliable and cheap, take them from point A to point B. Some are willing to sacrifice quite a lot more in order to get the car that they really want. Stick around to the end of the video to find out what method would be best for your own preferences and situation. This is 4 Wheel Finance, a channel dedicated to helping you make smart financial decisions. Before I dive into the first rule, these videos take quite a lot of time and effort to make. Please give it a like, subscribe, comment down below what other vehicles that you would like me to review. First rule I'll be going over today is the 24/10 rule, and this states that you should put at least 20% down, you shouldn't finance it for more than 4 years or 48 months, and the payment shouldn't be more than 10% of your monthly gross income. Since the 2023 BMW X5 has an MSRP of about $61,600, you would need to put down $12,320. With the average new vehicle interest rate of 3.86% and a 48-month term, this would bring your monthly payment to $1,100. Take note here that you're also paying about $4,000 in interest. Bankrate states that the average monthly insurance cost is about $148 a month, but this varies a ton from person to person. How old you are, where you live, what kind of car you drive, your gender, everything like that. So use that smart financial link I've got there in the description. It's completely free, takes like 20-30 seconds, and you can get a little bit of cheaper deal on your auto insurance. This brings your monthly total to $1,257. Going back to that 24/10 rule, given your monthly cost is $1,257, you would need a monthly gross income of $12,576.10, which would add up to about $150K annually to be able to afford something like this. I really encourage you to take a look at the opportunity cost here. If you were to buy a cheaper $5,000 or $10,000 car and put what would be your car payment of $1,100 in the market instead, over the course of 5 years with a pretty conservative 6% rate of return, this would turn into about $77,477, gaining about $11,000 in interest in just 5 years. Take a look at those Acorns and M1 Finance links I've got down there in the description below. It's very easy to get started investing, and I highly encourage you to get started as early as you can. Even a small amount of money can turn into something pretty special over a longer period of time. And again, this is just for the first 5 years. If you were to continue that for 10 years, it would amount to $181,159, gaining over $48,000 in interest, again, just at that 6% rate of return. And for reference, the stock market averages around 10% return per year, so the 6% that I'm using here is pretty dang conservative. Next rule I'll be going over today is my own. I've made this up myself, and I think you should have at least a 6-month emergency fund. You should invest 15% of your gross monthly income into your 401k and max out your Roth IRA and ideally your HSA as well, but you need a high deductible health savings plan for that, so I will leave that one as optional. And yes, I know this seems like quite a lot of saving and investing, but I really don't give you a monthly percentage rule that you have to stick to in terms of spending. So it's up to you to decide if you want to spend more of your monthly spare income beyond your savings and investments on a vehicle, or if you'd like to travel more, buy more stuff on Amazon, go out to dinner more. I'm not going to yell at you once you get your saving and investing down. That's really up to you to decide. And I have the 6-month emergency fund. That's typically a little bit higher than most people want, but if you've got a monthly payment on something, it's best to have a high emergency account, especially if you work in an industry such as sales or a commission-based industry, because that monthly income can be a little bit spotty sometimes. And that investment portion gives you a little bit of financial security later in life when you're most likely going to need it the most. The majority of people will say that, well, nothing here is guaranteed. I want to spend my money now because tomorrow's not guaranteed. And while that's definitely true that tomorrow's not guaranteed, the average American lives to about 78 years old, and you're going to be thanking yourself when you get to 78 and you need that money. Next rule I'll be going over is the Dave Ramsey rule, and he thinks you should have at least a 3 to 6 month emergency fund. The vehicle shouldn't be more than 50% of your annual gross income, and you should purchase it all in cash. Given that the 2023 BMW X5 starts at about $61,600, you'd need an annual gross income of $123,200. Ideally, it's nice to purchase a vehicle in cash, as you would avoid having to pay that $4,000 in interest and your insurance would be a little bit lower. But not everybody has 62 grand in cash that they can put towards a car, obviously. Final rule I'll be going over today is the 1/10 rule, which was developed by Financial Samurai. Personally, one that I think the majority of people trying to build their wealth as quick as they can should really consider. It really doesn't allow you to buy a new vehicle, but it's set up to help you spend responsibly, which in turn reduces your financial car ownership stress and increases your net worth quicker over time because you'll have a little bit of money set on the side to be able to put in assets or opportunities that go up in value. This rule is pretty straightforward. It states you shouldn't spend more than 10% of your gross annual income on a car. It can be new or old, but obviously for the vast majority of people, it's probably going to be old. And you must own it for at least 5 years, but ideally more. And the theory behind this here is to minimize your financial stress, frees up a bit of money, like I said, to invest in assets or opportunities, things that are going to go up in value, so you have a little bit extra cash on that sideline to deploy when you want. It's a lot more stressful and difficult making important life decisions when you're worried about payments each and every month. Once again, this is 4 Wheel Finance. If you have any questions regarding car buying or how much of a car you can afford, please leave them down there in the comments below. And don't forget to check out that Smart Financial link I've got down there. If you're interested in lowering your auto insurance each month, it's a completely free quote that takes about 20 to 30 seconds.